What if I told you there is a retirement savings account that is better than a Roth IRA, a traditional IRA, your 401k? I'm talking about my favorite tax savings account, and that's the health savings account. Why is this account so awesome? I'm going to go through in this video 5 different tax advantages. I call it the quintuple tax advantage account. A lot of videos online you'll see will talk about triple tax benefits. There's 2 more tax benefits that are often ignored, okay? There's also other crazy strategies you can do with your health savings account that I'm going to go through in this video as well. Hi everybody, my name is John Lee. I'm a CPA, a tax professor, and I am passionate about helping people maximize their after-tax wealth. There are so many different strategies you can apply to become wealthy, and a lot of them have to do with the tax code and using it to your advantage. This doesn't just apply to the wealthy. These are things that anyone can do, okay? So, and I'm going to show you one of my favorites, the HSA today. And this is my 3rd video in my Retire Smarter with a Pension series. And I'm focusing on pension holders for this first one. So the first video we went through creating a baseline plan. There's a lot of things that apply to pension holders that don't apply to other retirees. And it's different for pension holders, so I want to focus on them for this series. The first video was the baseline plan. Go get the free version of the plan in the link in the description. You can do so much planning with just that, you'll be blown away. But after that, in the second video, I go through one of the best returns on investment you can get, the 401k match. 208% return in the last video. So check out those 2 videos. And then this 3rd video, I'm just pumped because I love the HSA. So we're going to jump into the case study. And as you can see, for this couple, last time in the first video, we set the baseline. Then we did projection 1 and 2 in the last video. In this one, we might do 3, 4, and 5 because there's a bunch of different strategies you can do with an HSA. So to start out, we saved about just doing that 401k match. In 2 years, we created an extra $37,000 in wealth, okay? And up to $40,000 if we went that Roth route, but we're going to show that we're going to increase the wealth even more by going the traditional route, their last 2 years of retirement, okay? So now let's do the HSA. And the cool part about this is if we go to the instructions page, if you're not sure, oh, where do I do these strategies and stuff, you can scroll down here, go to HSA contributions, and then adjust future years, and that kind of takes you right where you need to do the adjustments, okay? But following along, it brought us to the tax planning tab because we want to see what effect does the HSA have on our tax this year. To give you an idea, the husband in this case has the HSA, so we're going to do 8550. There's 2 ways you can fund an HSA. One is you ask your employer to withhold the money from your paycheck. And I'm going to go through why I like this way better, okay? You withhold it from your paycheck. The other way is you don't have any paycheck withholding, but then you pay it out of pocket. I'm going to show you why I love the paycheck method. So the first one, we're going to say the husband contributed $85.50 from his paycheck. Or let's put $95.50. They're 55 or older, so they get an extra catch-up of $1,000, and the wife can also do an extra $1,000. So we're encouraging them to open that extra HSA account so they both are funding an HSA. They only had the one. You're still on a family plan, but the catch-up rule lets you both fund an extra $1,000. Okay. So how much extra tax did that save? Our tax savings, remember before, was $2,288 from doing the 401k match. Our tax savings is up to $5,890, okay? So we're saving another $3,600 or whatever that was by doing these HSA contributions, and we're just putting it into an account, so there's big tax savings when you contribute to an HSA. The cool thing about doing it from your paycheck, we saved on federal tax and state tax. If you do the HSA contributions from your paycheck, you also get a decrease to your Social Security and Medicare tax, okay? So we saved an additional $807 this year by doing it from our paycheck. Just to show you that difference really quick, if you do it, I'm going to change those both to doing it out of pocket, and this is the kind of detail you get in here that I don't see you getting anywhere else, okay? If you do it out of pocket, you no longer get that Social Security and Medicare tax savings, so you're not saving as much money up front, okay? So that can result in, over a career, that $800 a year can result in substantial wealth growth. There will be people that say, wait a minute, if I'm decreasing my Social Security earnings, won't that have an effect on my Social Security benefit later on? You'll find that that effect will actually be pretty minimal compared to the savings you'll get from doing it from your paycheck. And it's just based on how your Social Security benefits calculated. I'm not going to go into all the detail now, but that upfront extra savings, I love it, right? So I'm doing it out of the paycheck. The other thing I want to point out is the husband retired this year. He's the one with an HSA. So my encouragement is open the wife's HSA and do it from her paycheck, because now you're no longer getting that Social Security withholding from the husband's, but you can get it from the wife still. So we're going to do $85.50 from her paycheck to get that extra Social Security and Medicare savings. That's where you get the two other tax benefits, the quintuple tax benefit, compared to others that say triple. We've already covered 3 benefits. One was the deductions for federal and state, and now we're doing Social Security and Medicare. We just added in, okay? And I'm realizing that's 4, but yeah, you get the picture here. So we're doing $85.50 out of the husband's or wife's paycheck, and we're going to do $1,000 out of the husband's, at least for this year of retirement. And then in subsequent years, if he doesn't have a paycheck, there's going to be no Social Security and Medicare savings. But for this year, there are. So now what we're going to do, remember what I like to do is when we're doing these strategies, I love taking whatever tax I'm saving with these strategies. If you have enough cash flow, and there's plenty of cash flow for these guys because their budget, I'm tossing it in a Roth. You know, you want that tax diversification in retirement. I'm not an all Roth guy. I'm diversified because then that gives you so much flexibility. Okay, so $55.49 we're going to put into the Roth IRA. Okay, $84.25 $446. In our projections, let's go over to the 5th tab. We're going to lock that in. Set projection 3. Okay, and again, because this is in testing phase, you don't have the option to set that yet, but that'll be out soon. But if you want to join that first group, we'll get started now and get yours all squared away. We just added, just doing that strategy, we added another from 36 to 46 because we were working off projection 1 after the first scenario. So we just added another 10 grand to our final net worth. Is that super beneficial? Yeah, I mean 10 grand, but we're missing something, okay? Because we just funded the HSA account. We haven't paid anything out of it yet. If you'll notice, this is saying at the end of your life, you have $118,000 in the HSA account still. Why do we not want that? Well, HSA is actually one of the worst accounts to inherit, although it's my favorite account for everything else. When you inherit it, whoever inherits an HSA becomes taxable immediately. It's not like a traditional IRA or something where you can take 10 years to withdraw it. It's taxable immediately. But these guys will have much more than $118,000 in health expenses throughout their career. So I want to show you the last part of their strategy. Okay, so it's fund their HSA through paycheck contributions, but then they're not using that. You know, with an HSA, you have a debit card where you can use it on your medical expenses. They're not going to do that. And you're like, wait, why wouldn't they do that? Look at this strategy. If we go over to our future planning tab, in this cash outflows section, we can see how much we've accumulated in our HSAs. And they've started small, but if we're not spending down those balances, the reason you wouldn't spend from your HSA account, use your credit card, get the credit card points, and then pay it off, right? Or use other funds, because what that happens is the bigger you can accumulate these accounts, they're growing tax-free. So any of the growth, that's the 4th benefit. Any of the growth is tax-free, okay? So if we're using them as fast as we can, maybe they only last a few years and you don't get that benefit of the growth. But if you let them grow and you're paying with a credit card, what you need to do is save your receipts. And I use this strategy and I love it. I just have a document, a Google Doc, where every medical receipt, I pay it with the credit card, get points, then pay off the card, and then I save that receipt in the Google Doc, okay? And, you know, you just keep accumulating those receipts. And then later on, maybe you want to buy another property or something. You're like, where should I take the funds from? You can take any of the total amount that you've accumulated in receipts, you can take it out tax-free. Take a distribution of 20 grand and buy a property or do whatever you want with it, okay? But the point is, in order to take advantage of compound interest, you need these accounts to grow bigger. If it's a small balance, you're not getting that big growth. These guys, I mean, they only contributed, I mean, not a ton, 17 grand, but, and then, well, for 2 years they contributed, so they end up contributing 30 grand, and they end up with, if they let it accumulate for their whole 118 grand. See, and all that's tax-free money. Well, since their medical expenses are much greater than that, they're just they're going to then take a distribution for all of their medical expenses. So what they would do is they'd say, okay, from the husbands, you want to do it the year before death so the inheritees aren't doing this? You're doing, okay, 71,432, we're going to pay for those medical expenses, and you'll see net worth jump by a ton, because that would be taxable income that we're no longer taxed on, 47,404, okay? So now we've depleted those HSA accounts and increased our net worth substantially, because now we get all of that money tax-free. You just reimbursed it, you can use it for whatever you want. I love that strategy, okay? So let's jump to, what does that look like in our projections? We were at 8425, but we had that huge balances that the inheritees were paying tax on. Let's reset projection 3 to finish what we started. 8456. We get another 37 grand. So between just using that HSA strategy, we just increased their net worth is now up 78,000. We just increased it by another 42,000 from projection 1. Okay, crazy the amount of wealth just understanding these strategies. You're going to have these medical expenses. Why not fund an account that gives you all these tax benefits, grows tax-free, you take it out tax-free. You're never taxed on this account. That's why it's so powerful, okay? And medical expenses are going to be one of your biggest expenses in retirement. Why not have a tax-free account you can just draw from, okay? So there is your first strategy. The next one I want to cover, you can see up here I've laid them out. HSA strategies, that was projection 3. The next one we're going to do, I'm actually going to leave it as payroll deduction contributions, okay? Because we want to still show you the most beneficial contributions. We're going to max out the HSA, but instead of letting it grow and accumulate, we're going to use it immediately, okay? And how do you do this? Well, if we go back to our tax planning, when we fund that HSA, we put 1,000 in the husbands. What we do is expenses paid with the HSA, we just put 1,000, meaning and whenever you put money into the HSA, you're using it for medical, which also feels good psychologically, right? You're putting money into this account, and it doesn't have to come out of checking or on a credit card. You can just pay it with your HSA debit card. It feels good. We were doing that for a while, but then I was like, oh, I love that accumulation. So we've switched. But this method isn't bad either. There is an effect on your wealth, though. So if you're paying it out immediately, like I talked about, so the same thing for the wife. I messed up the husband. We didn't max it out fully. I'm going to go reset that. They can do 9550 because they each can do 1,000 extra. So let's reset in future planning. That gives us an extra 5544. We're just going to reset that to 52,948, and that's just going to increase their net worth even more. We're just going to reset projection 3. Okay, and now we'll continue. I just noticed that error. Better fix it. So now both the husband and wife, there's medical expenses. They're just going to deplete. They're going to fund the HSA and deplete the expenses, okay? And just as soon as they have them. So we just did the depletion that's built in, but in the future, we need to also delete any of the future withdrawals we took, because you can see the wife's account, they used it immediately, so there's nothing else to withdraw. Husband still had some that carried over, so we're just going to take. And that's why in this cash outflow section, I have what you pay for your health insurance, index for inflation from your original budget, the health insurance, and the medical, okay? You can't start using the HSA on the insurance premiums until you're on Medicare, but at that point you can. So we're going to take $10,699, and that's the estimated medical expenses when they're 65. So $10,699. And then whatever's left in the account, 7102, 7102. So we've depleted the husband's account, okay? And it's slightly, there's a dollar there because of some rounding. But see how fast someone, with how much medical expenses they'll have in retirement? They'll deplete it pretty fast, and they're still paying out of pocket anyway later on. So why not in these first years, see if you can not pay it out of pocket and let that enjoy that tax-free growth? Because look how much it cost us in wealth. We will go to our projections. Let's set projection 4. Okay? And we end up, current year, we're still getting that full tax savings because we're funding the accounts. But since we're using them as we're going, it's, and at retirement, we're not seeing a huge difference because we're not using them quite as much in just a year or two. But in the end, you're missing out on 14 grand in wealth accumulation by using them immediately. Okay, so that's kind of, we go from 84.59 to 84.44. And that's 14 grand, and they only had 2 years to fund this. Okay, so think of someone who's much younger. If you have kids, talk to them about the HSA. And this isn't investment advice, right? This is educational purposes, but I just want you to see the power of these accounts, like what you can accomplish with these accounts. Okay, so to finish off, projection 5, I just want to show you, we're going to back out the medical expenses paid earlier. So we're going to go and back to our future planning. Instead of withdrawing that early, what we're going to do is on our tax planning tab, we're going to save our receipts and let it accumulate, okay? But the difference for projection 5, I just want to show you the difference in total savings if we are doing the paying out of pocket versus from our paycheck. So we'll change the husband's to out of pocket 1,000, and we'll change the wife's to out of pocket 9,550, and we're going to still save our receipts, okay? But in future planning now, we'll let it grow, and you see the year before death, we're going to refund ourselves. And again, you could refund any time you have those receipts, right? And then 52,948. So 84.55. Okay, so, and again, the longer you have this, the bigger the difference is going to be. But in our case, if we do out of pocket, well, let me show you first in the tax savings. We lost that Social Security and Medicare, right? So we don't get that. And so it's going to affect how much we put into our Roth IRA. 5,083 is our total tax savings. And we end up, let's set that as projection 5. So funding out of pocket versus from your paycheck, you know, it's not a huge, 85.54 to 76.656. So it's like 4 grand. Okay, so I want to show you. Remember this comparison tool. If you didn't watch the last video, I love this because we already have a comparison here. But sometimes I'm like, oh man, this is like a final comparison or a retirement comparison. I want to see the comparison every year. So you can come into this comparison tab and you say, I want to compare projection 3 and 5. Okay, and that was just the one difference is payroll versus out of pocket. And I'm gonna hit compare scenarios, and this is gonna run through and compare year by year the differences. And this is that whole future planning tab with all the columns with all of the account balances, income, etc. We want to see where are you getting that difference, because you end up almost 4 grand better off, and that's just 2 years of funding. Okay, if you do it for more years, you're going to see a lot more benefit just from doing paycheck versus out of pocket. Okay, so the first year the benefit's only $269. I'm like, why is it only $269? Let's scroll over, because the biggest benefit was that $800 in tax savings, right? So if we scroll over to our cash outflows, you can see we saved $800 in tax that year, but because this projection is starting in September, it's only going to reflect, we're going to make an adjustment. That's where that $200 comes from. Okay, so $269 that first year, but the next year we're up to $1,000 difference. Okay, and because, let's go back over to our tax savings. Second year, you saved another $752 by not paying on Social Security and Medicare. What about that third year? That's gone because now the wife's retired. Okay, so then you're not seeing any difference from that funding. Now you're just, the distribution is when down at the bottom, because you had more to distribute, we can go over to our distributions. And I never adjusted the distribution for the second. They accumulated the same amount because you put the same amount in, so there shouldn't be a difference on distribution. So that is my favorite retirement funding account. Okay, and if you're starting super young, I mean, you could accumulate 2-3 million. Are you going to have that much in medical expenses? Maybe not. Another benefit to this account is once you've accumulated a big balance, let's say in retirement, you don't have, I mean, you're pretty healthy, you're not using it for medical, you can start taking out as a normal tax-deferred account, like a traditional IRA or a 401k, and you just pay tax on it. But the cool thing about it, it doesn't have RMDs, so that's why I just love that HSA account. In the next video, we're going to jump into maxing out the 401k and 457 account, whether it's traditional or Roth. We're going to jump into that a little more because they only got the match at this point. Now we're going to go back and max it out so we can, just diversify that money and where we're going to put it. If you found this helpful, please like the video. Please subscribe if you want to hear more and keep following this series. Also share it with someone you know that might be retiring soon or is just building up for retirement. And we'll see you in the next one.